Hello, everyone. Welcome to our part two of our discussion about uh, tax credits. We're now moving on to the child tax credit, probably the most common, mentioned back in chapter two a little bit. Okay. Um, this is the detail about it. We just kind of threw it in there to see how credits work back in chapter two. So here in chapter nine, we understand that the credit is for taxpayers with children, those that qualify as children. The definition is the same as we learned back in chapter 2. All right, a qualifying child. But they have to be, it's even more specific, have to be 17 or under. Okay, so as soon as they turn 18, they no longer qualify for the child tax credit. The child must be a U.S. citizen or resident. The child has to be younger than the person claiming the credit and unmarried. So that kind of goes without saying. It usually doesn't restrict too much, but that's in the law as well. $2,000 for under 17. Okay, it is phased out. We'll see what the phase out range is in the next slide. Okay, it is refundable up to 15. So it's like both a refundable and a non-refundable credit. $1,500 is refundable of the 2,000. And 500 is non-refundable. So you'd use the non-refundable part first, right? And then you'd have anything that's refundable to get back as a refund on your taxes. But it can be a part of it that you lose if you do not have tax liability. The $500 non-refundable credit, okay, it was added a couple of years ago, is provided for qualifying dependents other than children. So this is anybody who qualifies as dependent. Back again, our chapter 2 definitions fits as a definition of a dependent, but does not qualify for the $2,000 credit for the qualifying child. So phase outs. This one phases out like many others, but the phase out works differently than any other. Okay, it begins at $400,000 for married filing jointly. That's pretty high. $200,000 for everyone else. It's reduced by $50 for each $1,000 or fraction thereof that our AGA goes above those amounts. So while the amount is a nice flat amount, nice round 200, 400, easy, almost easy to remember, the fact that it's $50 for every 1,000 is somewhat complicated. Okay, so example, single taxpayer has AGI of 217, so they're over the $200,000 threshold by 17,000. Okay, exactly. Okay, her child tax credit will be the $2,000 for one child minus, okay, $50 times 17 is $850. So we're over by $17,000. Okay, for over $300,000. So that is how it's calculated then. So the actual amount would be $1,150 for the credit in this example case. So another example. Okay, Pat and Lisa have two qualifying children, ages 8 and 11, and file jointly. AGI 112, well under the threshold. Okay, what's their credit? Okay, without considering the limitation of child credit is $2,000 per child, $4,000 in total. AGI limitation does not apply. We're assuming, okay, that they have tax liability, so it could be refundable. All of that or cover their liability. Child tax credit cannot be taken for a dependent child age 18. That's true. Okay, not permitted if the child is over 17. Remember, they turn 18. Okay, Glenn is an unemployed widower, is a U.S. citizen, is unrelated to Fred and Marlene, lives with the entire year in their residence. So they're not related. Glenn is between jobs and Fred and Marlene are paying all his living expenses, provides everything he needs. Okay, can Fred and Marlene claim a $500 credit? Yes. If he's in their household the entire year, they do not have to be a relative. They actually fall into the definition of a qualified relative and therefore are a dependent. And that's all that needs to be in place for the $500 credit for other dependents. Okay, clearly not a child, so it doesn't, the $2,000 doesn't come into play, but the $500 does. All right. Next one is retirement savings contribution credit. Now, this is an interesting one. It's the only one that I know of where you get to what's called double dip, meaning you get a deduction for making contributions to your retirement plan. Okay? If you put money into a 401k at work, or you make a contribution to the IRA, it is reduced. That amount comes off of your AGI. If it's an employer, it literally gets subtracted out of your W-2 wages in box 1. Okay, the amount that you contribute to your 401k or whatever plan your employer sponsors. Okay, now for those that fit the income thresholds, and the income thresholds are on the low side, okay, you also can get a credit. So you already reduce your income by making a contribution to those retirement plans, but you also get a credit to offset any other tax liability you have. Okay. Now that some severe limitations, like I said. Okay. The total amount you can consider for the credit. There's no limit on how. Well, the limits we'll talk about in Chapter 11 as to how much you can put into your retirement plan. But the most that you can consider for the credit is $2,000, regardless of how much you put in. Okay, and the way this works, and the percentage you get credit depends on your filing status and your AGI, your income. So you can see if you're a joint filer, okay, between 0 and 43,500, you get a 50% credit. So if you put in $2,000, you get a credit of $1,000, half of it. If your income goes over 43,500, so now it's 44,000, let's say. Now, if you put in $2,000, you only get 20% of that as a credit. Your credit is now only $400, and if it and notice that's only $4,000 difference. Then when you get over 47,500, say 50,000, then you only get a 10% credit. So you put in 2,000, your get credit is only 200. And as soon as you're over 73,000, you cannot take this credit. And you see the similar thresholds for head of household and everybody else. Okay, single, married, filing separately. Okay, so these are the things. Thresholds are very distinct, meaning it doesn't phase out gradually. It goes from 50% of how much you put in to 20% if your income increases by $1 or $2, which is kind of crazy, but that's how it's written in the law. Okay, so some examples. Enrique and Lupe have a AGI of $52,000, married jointly, contribute $1,500. Okay, how much is their retirement credit? They, as you look at this thing, they're 52. They're in this line right here between 47 and 73. So they get 10%, okay, of the $1,500 they put in as a credit. That would be offset their tax liability. Roger, the head of household, made $2,200 contribution, AGI $26,000. He can only consider up to $2,000, right? That's the max. But he is, okay, under the 50%. He's in this line right here with $26,000 in between these two. So he can take 50% of the $2,000, not the $2,200, the $2,000 for a $1,000 credit. Next credit, adoption credit. Okay, these are things that Congress feels like we need some financial incentive to have help to make things work. And this is one of the things, 100% of the qualified adoption expenses paid. So all the costs, legal costs, everything that goes into making sure that an adoption happens, that often takes more than 1 year. Okay, so all of the costs are to qualify in the year that the adoption becomes final. Okay, the amount is $15,950 per child. So if you adopt more than one, then it can be 30, twice that if it was two. Okay, and you might file jointly to take this credit. And there is a phase out. Starts at $239 through 30 and is gone. $40,000 gradual phase out at $279 through 230. So that's a $40,000 range. So you take the credit or the amount that you spent, okay, multiply it by this formula, and you will get the amount of your credit that is still available. So, example, Levi and Isaiah incurred the following expenses. The adoption of their infant daughter was finalized in 2023. 2022 is $10,800. 2023 is $39,550. So it's over 2 years, but they all get to be counted in the year it gets finalized. Okay. So 0 in 2022 because nothing's actually become final. Okay, the total in 2023 it's below the limit. Okay, so they get to use all of it, and their income isn't high enough to cause a phase out. So they're good on that. So they get the full $14,750 in credit. That obviously offset a lot of tax liability. But it is non-refundable, okay? Second example, spent $16,000. Adoption was finalized, and all expenses occurred in the current year, so we don't have a 2-year issue, this one, okay? Their income is $246. How much is their adoption credit? Well, 16 is over the limit. Not by much, but it is. So we can't use the $16,000. We use the $15,950. Okay, still within the phase-out range. So we take the $279. That's the upper amount of the range. Subtract the $246. We get about 33 so in there. Okay, divided by the 40,000, and that gives about 83% of our credit is still there. Multiply by the $15,950, and our actual credit is $13,250 after the phase out. All right. Earned income credit. Very common. Okay. It is refundable. It's pretty complex in how it's calculated. Based on filing status, number of qualifying children, and earned income amounts. Usually it's easiest to look up the amounts in the table. The tables, EIC tables, are found in the appendix or the end of your chapter 9, not at the end of the full book for textbook, but at the end of chapter 9. Okay, it is an interesting credit in that as your earned income is low, you actually get more credit as your earned income goes up. So there's incentive to work more until you get to a certain point, and then it levels off, and then it starts to come down again with higher income. Okay, that's why it's complicated, easier to look up the table. When you use the table, okay, you look up the AGI of the taxpayer and their earned income. You do it twice and pick the lower of the two, okay? Because if they have other income other than wages and such like that, it can affect their amount of their EIC. Taxpayer must either have a qualifying child or meet certain criteria. Their income must be very low if they do not have children. It is higher if they do, okay? There's another thing that will disallow, okay, and it does phase out when your income is too high. It is for those with lower incomes. Investment income in excess of $11,000 will cause the taxpayer to become ineligible, regardless of what other income or anything else is in play. Okay? So it not matter how many kids or anything like that, if you're over $11,000 of interest or rental or dividend, other types of investment income like that, then you are not going to be eligible for the earned income credit. It is for working folks that need a little extra help to supplement their earnings from their wages. So this is the maximum amounts. Okay. No matter what your filing status, if you have one child, the maximum amount you can receive as an earned income credit is $39.95. 2 children, $64.03. 3 or more, and 4, 5, 6 doesn't add to it. It's still $74.30. And if you have no children, it's $600. That's the most you get if you're right in the sweet spot. And remember, it's lower than that if your income's on the lower side, and it's lower than that if you're on the income on the higher side. And in the middle, there's a flat, an area where you're going to, that's the maximum is what you're going to receive as a credit. Okay? So, example. Josh and Daniel both work and have one qualifying child. They earned income of $20,000. Okay? If you look up in the EIT tables at the end of the chapter, their amount is the maximum. They are in the sweet spot, let's say, okay? Their earned income is right where it is the maximum earned income credit, $39.95, okay? For one child, qualifying child. If their income is 32, okay, they're past that a little bit. And so they're going to start phasing out, and how that formula works is shown in this chapter, but their earned income credit is going to be lower because the income is over that middle range where they get the maximum. Okay. Head of household income of 16. Okay. Tax liability is $800 was the amount of tax refund owed. Okay. She has 2 children. She's in the range where she gets the maximum credit, $64.10. Okay. And then if she has a liability of $800, this credit $64.10 offsets the $800 she owes, and she gets $56.10 back. Because remember, the earned income credit is refundable. Okay. Last is premium tax credit. Purchase insurance through a marketplace because you couldn't find insurance elsewhere. Okay. Your credit is calculated based on what it costs you to buy health insurance versus what it costs you on the for a basic plan and compared to your income. So you're expected to spend a certain amount of your income on it, and if yours costs more than that, then you are entitled to a credit. Now, if you applied ahead of time, okay, and told them your income, they may have calculated the credit and actually taking it directly off of the amount you paid for your health insurance. If that's the case, you've already received the premium tax credit, and on your tax return, you're just going to compare what you should have received versus what you did receive as a credit. If you didn't get any credit during the year, you may, depending on how much you paid, you may qualify for part of that amount you paid as premiums back to offset your other tax liability. Okay? So, all the information that you need is received in Form 1095A. Anytime you buy insurance through the marketplace, at the end of the year, you're going to receive this form. It comes at the same time as your W-2 and other forms that you get in the mail that say important tax form received. It will give you the information that you need to calculate this. Again, fairly complicated, and there's no real tables to look it up, but most of your tax software will handle the calculations for you. We won't do those calculations. Just want you to be aware of it and the basic way that it works for this class.